While everyone's talking about recession and the yield curve inverting, all that sort of stuff, there's a very, very compelling case that the stock market could surge upward from here. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so I've shared with you guys before, the outlook looks a little volatile, right, in the market. And you can interpret that to mean, yeah, there's a lot of downside potential, and yeah, there's upside potential, but there's downside potential. Yield curve inverted. We've got, gas prices, oil prices doubled over a year. We've got the Fed about to tighten and starting to tighten. And so lots of reasons to be cautious, and I am, okay? But what about the reasons, the growing number of reasons why we could see the stock market surge from here? And I'm not playing two-faced. I'm telling you, there are legitimate reasons to say, well, listen, despite this caution, there's a few reasons we might need to be optimistic or should be optimistic and watch for the stock market to pop from here and surge upward. What are those reasons? Let's get into it. The first reason, and in my opinion, the most compelling, is right now, the Fed is continuing to be hawkish in their communication, being more strict and more aggressive. Hey, we have got to tamp down inflation, therefore we're going to be taking these extreme measures. One of the primary reasons to be optimistic about the market right now is believing the Fed might not be able to pull that off, which I personally don't. I think if the Fed tries, and as the Fed tries to, that could create some more tremors on in the stock market. But if they're not able to be as aggressive, or if they don't get as aggressive as they state they're going to be, there's a lot of upside in this market. Take a look at this chart. Right now, apparently, the market is expecting over 9 interest rate hikes this year. 9.6, nearly 10. Guys, this is unbelievable. If the Fed raises rates 9 times this year, that'd put the Fed funds rate, which started the year at 0 and was at 0 all last year, it put it up over 3%. We haven't been that high since, 2008, 2007, 2008. That's outrageous. Now, I could say it's justified because we're all paying so much for higher prices these days, but that would be an extreme, significant move. Apparently, that's what's priced into the market. And if we see something short of that, the market likely would view that as fantastic, right? And there'd be a lot of upside there, okay? Specifically also on the bond market. Interest rates in the bond market, even though the Fed has only increased their interest rate, just once, but the interest rates in the open market have gone up significantly, and this has meant the worst year for bonds ever. And if we see less interest rate hikes than what the Fed is forecasting, than what the market is predicting, we certainly could see a rebound in stocks and in bonds. And honestly, guys, I'm sort of optimistic about that, right? The Fed has been very hawkish for the past several months, and yet, as of last month, they were still net buying bonds. Their balance sheet was expanding still, despite all of us dealing with inflation and the Fed being so hawkish, so aggressive in their tone that they're going to start limiting and contracting what they're doing. Second reason for optimism in the market and why we could see a short-term pop, a big surge coming up, is valuations have actually come down a little bit. They're a little bit more manageable. Take a look at this chart here. This shows the forward-looking price to earnings ratio. So this is the price of the stock compared to the expected, the future earnings by that company, okay? And that road right in the middle shows the averages and the sort of the guardrails, if you will. So that middle is the average over 25 years, average of around 16.83%. One standard deviation higher, that's geeky. So one metric higher is around 20, and one metric lower is around 13. So what's this mean? Above 20, the market's expensive. Above or below 13, the market's cheap. And you can see we've been trending expensive, and I've been warning you of that. And yet so quickly, the market hasn't expanded. The market's basically been anything but flat since October. Up, down, up, down, up, down. And so over that time, we've seen maybe a healthy sort of contraction here. Consolidation period is what a lot of financial professionals call it. And we might, if there's still reason to expect valuations to be on the higher side, we could see the stock market pop from here in the short term to push valuations back up to these elevated levels. I think it's healthier where they're at right now. However, there's lots of reasons people believe, well, no, valuation should be stretched right now for all, for various reasons. And so, because valuations have come down, we could see a pop in the market pushing valuations back up higher. And then the final reason why I would expect, hopefully, I'm hoping for a surge in the stock market in the near term is right now, seasonally, we are in a midterm election season. Historically, they're a rough start to the year, a choppy summer, followed by a surge in the fall. Check out this chart here that shows the average. Now, this is over 90 years, but the average trajectory of the stock market in gray, all other years, where we see a surge for the first 6 months and then it sort of plateaus and bounces around for the next 6 months. Compare that to, in blue, midterm election years, where typically it's a little choppy to start the year, and then April, you guys know this, April is typically a strong month for stocks, okay? That's interesting. Then choppy during the summer, but leading into the election, there's weakness, and then the election happens and the stock market tends to rebound from there. Why? Because we finally have clarity. Typically in these years, there's a lot of challenges coming out of Washington, D.C. that traders worry about, okay? And once that is clear, what path we're heading for at least 2 years in D.C., the stock market tends to applaud that and rebounds pretty quickly from there. Will this year be like normal years? Gosh, if there's any year that won't be, it'd be this one, because we've got so much Fed tightening apparently, and there's so many other changes that we're still digesting from the pandemic. But it's possible, it certainly is possible, this could turn out to have a similar trajectory as normal midterm years. All right, so what do you do with all of this, guys? I've told you, I've shared with you before, I'm on the cautionary side, but there are reasons, legitimate reasons to be optimistic. And therefore, again, this is not a channel for stock traders, day traders, right? If that's you, then you're playing the market and you're working some sort of scheme. This is for you, those of you that are long-term investors or even savers, okay? And so even though I would tell you there's reasons to have been cautious and to still be cautious, that's to set expectations and make sure that you're taking appropriate and wise steps in your overall financial life. But just like there's those reasons for being cautious, there's legitimate reasons for being optimistic on the stock market, and we could certainly see a surge in the stock market later this year. If you are aware of sort of the risks and abandon ship and put everything in cash or in low risk, you could miss out on these very legitimate reasons why we could see a boost in the stock market. So what should you do? Make sure you're following a disciplined investment strategy and philosophy, okay? Make sure there's discipline applied to it, and that you're not just moving your investments around based on your emotions, okay? Second, make sure that overall that diversified and disciplined investment strategy is consistent with your financial goals. If you're saving up for a certain purpose and your investment strategy isn't connected or isn't in tandem with that purpose, that's a warning sign to me, okay? So if you're in your 30s and you're working an investment strategy that's very conservative, but you're not going to touch this money for 30 or 40 years, guys, that's an inconsistency. But and same thing is if you're 60 and you need this money to last you for 30 more years, but you've put it very, very conservative. Now, to me, that's a warning sign, okay? Make sure you're following a disciplined investment strategy and that strategy is connected to the purpose for those investment dollars, your retirement or long-term financial plan. Work with your CFP on all of that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.